So today I'm going to talk about a new stock that I bought. Now this new stock that I bought, I wasn't actually planning on buying just yet. It was a stock that I actually had on my watch list at the start of the year. And I identified this as an opportunity to the back end of 2023. Now, given that the stock is actually performing very well and actually better than what I thought it was going to do, and actually recently it had a 20% drop off earnings, that I actually looked at these earnings and thought these were actually really good earnings. So the combination of that it's overachieving and yet the share price is going lower pushed me to buy this stock a little bit earlier than what I was planning on doing, but I don't mind this opportunity. So I'll share this stock with you today, the new stock that I've started buying. It's going to be a bit more of a smaller position just because it's in the fintech industry and I've already got quite a few fintechs in my portfolio, and it is an unprofitable company at the moment. Given a couple more months, it actually could potentially be a profitable company. So just with that element of risk there, I am keeping it a smaller position for now. But ideally, if the stock can go lower from here and I can buy more shares at cheaper, that'd be the most perfect combination for me. So I hope you enjoyed the video. If you could smash the like button, just because it does take a few hours to put this in-depth research video on a stock together. That's why not many YouTubers do these in-depth stock videos on stocks anymore, because it just takes so long to do. So if you could just smash the like button and we'll get started. And as always, if you want to know what I'm buying and selling in real time rather than waiting for the videos on the YouTube channel, the place to be is on the Patreon. It's only £5 a month for the price of a pint, or nearly a pint depending where you're from. And on there, as well as my live buy and sell alerts and a Discord with 500 members on to talk about stocks, including me, you also get 2 exclusive videos a week. We just dropped one yesterday, and for £5 a month, I think that's pretty good value for what you get. It's probably why it's the highest Patreon to subscriber on the YouTube scene, so maybe give that a little bit of thought. And also, if you want a free share, join through the link in the description for Trading 2 and 2. That's the broker that I use, and you could get a free share worth up to £100. Let's get stuck onto this video today. So the stock is Sofi. So the stock is currently $5.41. Now, ideally for me, I'll tell you straight up at the start, I would like to get this stock under $5. That's where I want to be buying. So that's actually where I did when you see this little drop that we had here. Since then, there has been a bit of a recovery, and I am now up on this position over 10%. A few people would say, oh, that's good that you're up. For me, I look at that as a negative. I wanted this stock to go lower and lower and lower so I can buy cheaper and cheaper and cheaper. Sometimes people find that a hard concept to get your head around, but I prefer averaging down on a position, getting it for cheaper, because in the long run that will make you more money if that stock performs. So I have bought a little bit of a starter position, but I am at the point where I'm now watching and hoping it goes lower. Under $5 is where I want to be buying. So it's a 5 billion market cap company, and this stock came onto the stock market in 2020. Obviously, that's when obviously a lot of stocks were booming up, and you can see here it came around about $10, and then it went all the way up to $25. It was quite a volatile stock actually. Dropped, went up again, and then it obviously peaked out around the beginning of that stock market crash in 2021 into 2022, and that's when it was $22. And since then, it's kind of been hovering around this kind of $4, $6, $7 range. It's been going in and out of recently. Had a 52-week high of $8. And recently it had a run up in the start of the year and then giving a little bit of it back at the moment. And like I said, this initial big drop that happened here is where the stock went down around about 24%, and I bought the dip. I bought the dip on this stock because I looked at their earnings, and you can see here Sofi Technologies Q1 earnings beat estimates and higher segment revenues boost financial 23 outlook. And ultimately, when I looked at these earnings and then saw the drop, which caused a drop of 24%, this was where I wanted to buy. And we'll come back to these recent earnings in a little bit. We'll start with what the company actually does at the moment. So Sofi is a digital banking platform, and the digital banking space is growing rapidly at the moment. This is a disruptor into the more traditional banks, the likes of JP Morgan, for example. Those banks that have the kind of traditional models of more, say, physical locations, and not the kind of ability to use different financing products through the same app. Now, Sofi is that. It is to be more efficient, it is to be offering more products to its customers and hopefully cross-selling them products and having your finance in one place. Now, digital banking is growing rapidly at the moment. You can see here the growth that it's going to go on in the next 10 years. And you can see here at the moment from 2022 to 2030, it's supposed to be growing at a 19.9% CAGR. Let's call it 20%. So yeah, it's going to be very good growth in the next 10 years, and Sofi should benefit from that. It's also going to benefit from all the other ways that it operates. One of them being that it has received regulatory approval to become a national bank as well. But when we look at the old investor presentation, which this one is a couple of years old now, you can see here they have 4 factors: fast, selection, content, and convenience. So faster ways to do everything: apply and borrow money, open account, buy and sell stocks, deposit checks and access cash, and also send money to a friend. And doing that also by having a good selection, having the content, and also the convenience of it, easy to use, anytime, any platform, any place, and also being a very simple app to use to get all of these features. And you can see here, Sofi is the only company to provide the solution in one app to try and offer the convenience, the cheaper fees, and also have everyone come to one place to cross-sell some of these products. And you can see here the member growth has been rapid. Even with the boom in 2021, the growth has still continued in Sofi as members increase. And even on the recent quarter, you can see here Q1 23, members grew 46% year over year. Now at some point, this member growth is going to slow down slightly. However, the ability to then sell on multiple products to the members on this platform is also the very exciting expansion for where Sofi will go in the future. And that was clear in the recent earnings, when you can see here that the total members were up 46% year over year, and they added 660,000 new products during the quarter and ended up with nearly 8.6 million total products and 46% annual increase as well. And this is all while decreasing the sales and marketing. This growth is not being funded by sales and marketing. As you can see here, the actual sales and marketing declined approximately 100 basis points as well, which is also very impressive. And when you look at the financial products, this was where a lot of the growth in the platform was. You can see here money was up 48%. You can see the invest part, which was still very good when you consider the stock market that we have had, was up 22%. The credit card was up 65%. Referred loans was up 159%. Relay was up 98%, and at work was up 71%. And the total financial service products was up 51%, which was very good. This supported a lot of the weakness in the other parts of the platform, like the lending. When you actually look at the lending, which was a little bit slower, around 7%, this was affected by 2 main categories. So this company actually started off as a student loan business. Now this is a massive space at the moment because obviously student loan forgiveness is going on. So you can see here from 2022 to 2023, this has been nearly a 500 million headwind on the company. And the thing is with the student loan as well is that this is something that will actually come back into the platform in the coming few years. So this has been a massive headwind for the company, and yet the company has done very well, and this is also going to be something that comes back in the future, which is really exciting. Also, when you look at home loans, you can see here this is down 71%, obviously with the higher interest environment that we're currently in as well, and this is also something else that's yet to come back in the business. So the big thing is this company has been posting fantastic numbers with these 2 massive categories that are causing pressure at the moment, and these are good things that will come back in the future. And actually on the conference call, Antonotto went on to say that he actually has not even factored this tailwind they will get into any of the financials yet, which is also very exciting. And then when we go look at the recent earnings, you can see here they had a EPS beat of 0.03. The revenue was up 43% year over year, beating by 23 million as well. And you'll also see here they actually hiked up their outlook as well for the rest of the year. For Q2, you can see here they were guiding for 470 to 480 million versus a consensus of 463, which is very good. Adjusted EBITDA to be in the range of 50 to 60 million, and also the financial year 23, you can see here they hiked up as well on the revenue, and you can see here adjusted EBITDA as well was hiked up from 268 and 288 from the prior guidance as well. So there was a really good hike up, and you can see here shares were actually up on this time frame when they originally came out. The shares was up 7%, and then later in the day they actually turned negative and actually caused a 24% drop. And that was ultimately my reaction as well with the recent earnings. I was like, these are really good earnings, and then it dropped, and I was like, okay, I'm going to have to pull the trigger a little bit here. It's also worth saying as well that, as you can see here, the revenue was up 43%, and also net losses as well was incredibly driven down. You can see here that they actually went from 110 million loss in the prior year to 34 million loss, which is a massive improvement. Management also said they expect to reach GAAP profitability as well by the 4th quarter of 2023, which is also very good to see. So given the strong growth, given the outlook hike up, given that we're going to see GAAP profitability at the moment, why is the company having such a crater on the share price? And that was what I was ultimately trying to find out when I was buying this stock. Well, also Sofi has another part of the platform as well. In 2020, Sofi acquired a banking tech firm Galileo for 1.2 billion. This is the same technology company that also powers the likes of Robinhood and Revolt as well. So what does Galileo do? Well, Galileo is a bit of an Amazon Web Services in the fintech space. It is what people actually point out to being the biggest moat of Sofi. And the best way to sum it up is this article from Seeking Alpha, which basically says Galileo isn't a bank, it isn't a regulated entity, but it empowers other fintech platforms. Galileo provides an API, application programming interface, and all the technology tools required to offer digital banking services. Without having a physical bank presence, it maintains a ledger, authorization, settlement, fraud, fund movements, and transfers all digitally, and many more services. And Galileo serves many accounts here. Now, you can see here the growth has been rapid, but it did slow down a little bit in the recent quarter, and this was due to losing a client. Now, I'm thinking that the big drop realistically on Sofi that we're having at the moment, and even though these earnings were very good and we saw the pop off and then the drop off recently, is when people actually dug into the financials and saw that Galileo accounts were actually decreasing. Now, obviously, this looks like a short-term issue which will be solved, but I think this is what has caused the buying opportunity inside this company. However, with that even considered, you can see here that the revenue growth has still been very strong for the company, and also when you look at an adjusted EBITDA point of view, you can see how good the profit has been driving up for the company as well. Now, the company is currently led by Anthony Noto, which he currently did work. He was the managing director at Goldman Sachs. He was also the CFO of the National Football League and also the COO of Twitter. So obviously has a lot of experience and also experience in the industry at one of the big names of Goldman Sachs. Now, the company does currently have 80% gross margins and it is trading at a 3.1 times sales, which doesn't look too big considering the growth that you are getting here. It's quite hard to value this company because, like I said, we could use adjusted EBITDA, which I think at the moment is currently on 2024 levels, is around about 10 times adjusted EBITDA to the enterprise value, which obviously isn't actually too bad when you look at that point of view. But you can see here the growth that the company has had and will have going forward as well, which is absolutely rapid growth. And I think it could actually be a little bit higher when you factor in that the home market and also the student loan business still has to come back. I mean, you're talking automatically there, potentially an easy 500 million recovery in that sort of space. And then you factor in the growth as well. I think we could quite easily see 3 billion revenue closer than what analysts are expecting here. But the key thing is losses as well. You know, we talked about this is actually quite a hard company to value because it is currently not making profit. But as you can see here, as we get closer to the back end of the year, the losses once again come down, and actually in 2024 we should actually see the company turn profit. As we showed earlier, we should see GAAP profitability as well coming in. So we are going to see 37 million profit. Obviously that would still put it at a trading high of a P ratio, so that still won't be a very good metric to use. But that growth, as you can see here, analysts are expecting very quickly to jump from 37 million up to 228 million in profit. And obviously from that multiple you'd be around about 25, 26, 27 times earnings, which isn't that bad at all when you're considering the growth that you're getting here and the profit side of it. So that's also pretty good. Balance sheet wise, it's pretty healthy. There is debt on there as you would expect for some sort of fintech platform like this, but they are sitting on a good amount of cash, which is fine. And you'll see here in the ownership as well, there's been quite a lot of shares bought, especially by the CEO, which is Anthony Noto, as we just spoke about here, which is a really positive sign that he's been loading up a lot of shares at the moment in that $4 to $5 range, and even last year he was buying a lot of shares in that $6, $7 range as well, which is really positive to see. And like I said, there's not really many metrics we can use for this one, but you can see that it did used to trade at a 13 times sales, and it is down on a forward basis down to a 2. Free cash flow is down to a 29, and as I said, adjusted EBITDA wise on a 2024 basis, it is down at a 10. So only when you look at Sofi, you've got a company that's executing at the moment. You can see some certain tailwinds that are going to be coming up for the business as well in the coming few months. And considering this kind of softness with Galileo being the only impact at the moment, I don't think it deserves to have the drop that it currently has right now. Now, given all that, like I said, there's a few things that still need to play out. And I do look at the company at the moment, and like I said, for me, I want to get this more into the $4 range, ideally into the $3 range, and that's where I'll be patient to wait if it buys. But if you do get at these sort of levels, obviously you bring all those metrics down that it's currently trading at, I think that comes a really good valuation for this company. The valuation for a company that has just come off increasing the profitability, getting to profitability, growing at 43% year over year. the members that they're increasing, the potential they have to then cross-sell to the members as well. And as they add more and more products to cross-sell, I think this company will do very well and will become that one-stop place for finance for people to get access to everything they want. Combine that with the student loan business coming back as well, which will be a massive tailwind in the next few years. This looks like a very interesting fintech play for me at the moment. So yeah, I did buy some more. I will say that ideally I would like it more towards the $4, $3 range, but I did buy some shares when it did have the dip off the earnings. From that dip, I am up on the position, but I've bought it and I am watching now, and if it goes down a little bit lower, I'll buy a couple more shares, so we'll see what happens here. Hope you enjoyed the video anyway, guys. Smash that like button. If you're new around here, subscribe, and I'll see you in a bit.